Hello, Kurt Jackson with KJ Financial here. We're now in that second module, towards the end of that second module of our Retirement Accelerator Blueprint, where we're going over the 10 biggest risks in retirement. And number 9 is deflation risk. So what is deflation? Well, deflation is the decline in the overall price of goods and services. So we should first talk about why we may be seeing deflationary pressures on our horizon. See, there are 3 major factors that can cause deflation. It's debt, deleveraging, and demographics. Let's look at each one. So debt. As we produce this video, the United States government is over $31 trillion in national debt and growing by the second. So what's debt? Well, debt is simply taking from our future to spend it today. So by definition, our future is going to be $31 trillion less than what it could, would, or should be in America. And despite this grim outlook, when you look around the world, we might be the cleanest shirt in the dirty laundry. See, the world debt clock shows that the 3 other biggest economies around the world, the European Union, China, and Japan, are over $42.6 trillion in debt. And you look at Europe, you've got Greece, Portugal, Spain, and Italy. They're in terrible shape with no real end in sight. The Greek situation's not solved, not even close. And if Europe's debt bomb explodes, it could cause a global depression. Japan's even in worse shape than Greece, but we never hear about Japan. And the reason you never hear about Japan is because most of their debt is held by their own people. So Japan's debt to GDP, gross domestic product ratio, is significantly worse than Greece's. However, Japan has been in a deflationary economy for over 30 years. And think about that, 30 plus years of a 0% interest rate environment. What could that look like for retirement investors? Well, the Nikkei, which is Japan's major stock market, was at 38,586 on December 18th, 1989. Well, on November 14th, 2022, when we pulled this for this video, it was at 27,963 and has never been above that December 18th, 1989 high since. So imagine the impact on investments in that market. Understand that all of this worldwide debt would reduce global growth for decades. It is highly deflationary. Deleveraging. So look, most of you have had some debt. You've had student loans, auto loans, mortgage loans, credit card debt, those types of things. So let me ask you, what happens when you're paying off your debt? What aren't you doing with your money? Are you spending or saving it? Probably not. At least if you are, you're not spending as much or saving as much as you could have if you didn't have debt. So let me ask you another question. How do governments get out of debt? See, there's 3 ways, but we normally only hear of 2. One is to raise taxes and 2 is to cut spending. The third one is growth. Now, we rarely hear about this one. What happens to an economy when you raise taxes and cut spending? Don't you strangle the economy? So this deleveraging or paying off debt is also highly deflationary. Demographics. So as 78 million baby boomers head into retirement, we are all witness to the aging population in the United States. While Americans age, Europe is older, Japan is very old, and China will get old before they get rich. So did you know that there are more adult diapers than baby diapers now sold in Japan? So in China, over 20% of the population is over the age of 55. By the year 2050, in China, the number of people considered senior will equal Europe's total population. According to a Harvard study, by the year 2030, they expect over 133 million of the population in the United States will be above the age of 50. It's an increase of 70% from the year 2000. So here's the economic problem. Do old people spend any money? Think about it. How much money do your grandparents spend? Almost nothing, right? And isn't that going to be you in maybe 10, 20, 30, or 40 years or so? So who will buy all these big houses? Who will spend money to keep the economy growing? The millennials? I don't know. Think again. See, aren't they loaded up with student loans, aren't making the wages of their parents, and they don't want a big home? So debt, deleveraging, and demographics are the 3 main reasons for why we're seeing deflationary pressures on the worldwide economy. Doesn't this make protecting what you have even more important? So if these types of things impact the market to slow down growth, does that mean the stock market won't go up? Still want to still go up and down, just maybe not as much movement, or maybe more downs or bigger downs, or maybe volatility's higher. So could we see a long-term overall decline like we've seen in Japan? Well, we could. So in a market that's moving sideways or down over time, can you grow your wealth following buy and hold? Maybe you can if you're putting new money in, but how will you protect that new money from losses as they happen? So if you're trying to protect and grow what you have, will a sideways or downtrending stock market help you build wealth? How great, excuse me, I had to take a little drink. How great would it be to have money in a financial vehicle that never loses, is able to grab gains up to a cap, lock them in on an annual basis, and protect them from and protect that all that money going forward? So remember, we said Japan has been going through deflation for 30 plus years. So we have many economists who are saying that the U.S., could be heading the way of Japan. So with that in mind, would it make sense to evaluate strategies that we could implement to help combat what could be a lengthy deflationary market? So how about another strategy that we haven't shared yet? It's called the trigger strategy. So the way it works is if the S&P 500 is up at all, it triggers a return of, let's say, 9.55%. So if the S&P 500 was up 0.1% or up 15%, you would get 9.55%. If the S&P 500 is down, zero, still your hero. You haven't lost a penny. So could a strategy like that be good in that type of market environment, a deflationary market environment like Japan's been experiencing for more than 30 years? So hypothetically, if we assume we could have the same annual cap strategy or this new trigger strategy linked to the Nikkei, it doesn't exist, but I wanted to see how it might perform if we experienced a deflationary market over time similar to what Japan has experienced. So let's assume we're linking to the Nikkei from the beginning of 1983 through November 30th of 2022. That's almost 40 full years. Give me a little grace here, and we're going to assume that that's through the end of 2022 for our comparison. It's just a hypothetical one, so it's not like that last month would have made or break anything, right? So this period of time included some really big up years leading into 1989. So we're not just trying to look at a bad period of time. We'll assume no fees, no dividends, and just base it on what the Nikkei did each year. So if we started with $100,000 at the beginning of 1983, over that 40-year period, your 100 grand would have grown to $349,768. That's an average annual return of 5.69% and an actual return, a CAGR of 3.18. It's a big difference between those two, 5.69 to 3.18. Does that sound like it's a good time for retirement investors to be in the market? With our 13% annual cap strategy, no fees, no dividends, after 40 years, the balance would have been $1,172,513. So it's an average return of 6.52% and an actual return, or CAGR, of 6.35%. Notice the difference between those two isn't very much. So with the average return of 6.52 and the CAGR of 6.35, what's that tell us about this option? Wasn't it extremely efficient? That's what we need, is efficiency, right? That's what we're looking for with your money, right? So our annual cap strategy would have netted $822,745 more than just the Nikkei with all the gains and all the losses over that same 40-year period. So would you consider $822,745 more to be significantly more over a 40-year period? So what would the trigger strategy potentially look like? Remember, the trigger strategy with a 9.55% annual cap, no fees, and no dividends after 40 years would have been $977,934. That's a full $638,166 more, with an average return of 5.97 and an actual return, or CAGR, of 5.87. That's even a little more efficient, right? We looked at a 40-year period. What would happen if we analyzed 30 years? So we went from 93 through 2022. $100,000 in the Nikkei would have an ending balance of $165,668, an average annual return of 3.86%, and an actual return, or CAGR, of 1.27%. That's really ugly. And that's the problem you have in a deflationary environment like Japan's been experiencing. Doesn't that really highlight that devastation? Yeah. I mean, does a 3.86% average return and an actual return CAGR of 1.27 look like an efficient investment for your money? Those losses are killing it, right? So the annual cap of 13% would have ended with $498,389. That's $332,721 higher, with an average annual return of 5.66 and an actual return CAGR of 5.5. Isn't that much more efficient with your money? So the trigger with a 9.55% cap would have ended with 516,404. That's 350,776 higher, with an average return of 7.3% and an actual return or CAGR of 5.63%. In our random 30-year sample, didn't the trigger strategy slightly outperform the annual cap strategy? Okay, so it might be the way to go. We don't know, but it might be, right? Didn't both our alternative strategies significantly outperform what the market would have done? So how about we look at 20 years, so 2003 through 2022. Starting with 100 grand in the Nikkei, it ends with a balance of $326,781. So an average annual return of 8% and an actual return CAGR of 6.10. Still not that efficient, right? The 13% annual cap ends with $376,489, an average annual return of 7.0, and an actual return CAGR of 6.85. $49,708 more. So basically, the damage was done in those first 10 of the 30 years, right? Because we're doing 20 years, but it still didn't go gangbusters, but it did better. The Nikkei did better. Pretty efficient, though, isn't it? What the 13% annual cap can do. So the 9.55% trigger cap ends with $358,570. That's an average annual return of 6.69, an actual return or CAGR of 6.59, $31,789 more. Not quite as much as the 13% cap, but also really efficient, right? So the 20-year period shows slightly better than just the market, and the annual cap comes out ahead for the second time in our 3 samples. So which strategy potentially looks better during differing periods of a deflationary cycle? Which strategy would you prefer to be in for whichever of these scenarios you might experience? So in these hypothetical examples, could you really go wrong with either of the Retirement Accelerator blueprint strategies? So which strategy would you feel the most comfortable utilizing with all the risks, myths, lies, and so forth that you've seen so far? Now, come on now, be honest. The more you see about the Retirement Accelerator blueprint, the more you're liking it, right? I don't know how you couldn't like it. So that's retirement risk number 9, deflation. It could be a significant one. And it's probably one nobody has really talked about with you. So do you think it should be on the docket to cover for your retirement? All right, so the 10th retirement risk is another potentially big one. It's called regulatory risk. So click on the video below to check it out.